about that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 13th. Here are the top market stories that we're following for you at this hour. Banks deliver. Wells, Citi, J.P. Morgan report solid numbers, while Jamie Dimon warns of dangerous incidences, dangerous times. Thank you, Congress Gold. Consumer read here. We're going to get the latest read on confidence with Joanne Shu, director of the University of Michigan Surveys of Consumers, in just a moment. And risk tolerance, equities up, yields down, oil rally underway. We're going to see how much risk you should take on into a weekend of uncertainty. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, what do we got here with you, Mish?
Dangerous times. Certainly, that's what the consumer feeling right now. UMich drops onto our Bloomberg terminals. The headline number, 63.0. That's down from 68.1. The survey, 67. So that's a substantial miss. Current conditions cover through at 66.7. That's a big drop. Expectations dropped to 60.7. One-year inflation, wow. One-year inflation rises to 3.8, up from 3.2. And we have a rise in the 5 to 10 as well. I wonder if that's gasoline prices, but basically the consumer is feeling more gloomy and inflation expectations are rising, Alex. That's not a particularly good cocktail heading into the weekend.
No, those numbers are not great at all. We are seeing the bond market not moving as much. We're giving up some of the gains that we saw in the Treasury market on the front end, so yields down by just 2 basis points now, but we're still seeing money kind of flow in. Equities go nowhere yet, but this is not a great read for how consumers are feeling.
Absolutely not. Jamie Dimon warning a little earlier on the call, talking about the fact that the consumer is working through the excess savings. We've been talking about that for a while, though. That has been something that has been going on for really quite some time. I just wonder what this is in reaction to. There are potentially a number of different catalysts, Alex, here. Gas prices, I wonder whether gas prices are the contributing factor when it comes to that inflation story. But the further out story, I don't know. Maybe the consumer's just sort of mimicking what we're seeing at the long end of the bond market.
Yep. I don't know, so I think we should go to Joanne. Should we do it? Let's do it. Instant analysis.
We should, probably. I thought we were going to chat, but...
Well, we did chat, but we want to know why. Let's ask the person who did the numbers. Joanne Shu, University of Michigan Surveys of Consumer Director. All right, Joanne, what is leading the decline in expectations, and then UMich inflation expectations rising? What's leading it?
Overall, consumers are feeling much more stressed out about inflation than they were just a few months ago. And this is largely being driven by increased concerns over not just gas prices, but food prices as well. I think consumers earlier in the previous few months felt like that the increase in gas prices was possibly temporary. And now that it's been going on for several months, consumers are getting increasingly worried about the future.
In terms of what the implications of this are, can you just kind of walk me through what you think is going to happen next? If the consumer's feeling this gloomy, what are the implications for the economy?
I think the implications are not good because actually when you look at all the things that are happening in this country and also overseas in terms of labor strikes, war in the Middle East, and the resumption of student loan payments. There are a lot of things that are going on right now that could weigh down consumer attitudes and their willingness to spend. So given that, it's actually kind of surprising that consumer sentiment only declined by 7% this month. So I think there's a decent amount of downside risk in the months ahead.
So what I find weird is that if I just take a look at the daily national average gasoline prices according to AAA, they haven't moved. They've been going down. So I'm confused as to what that reaction is really to.
I think consumers might be a little bit confused as well. Well, not so much confused as they are unsure because, we saw the increases just a few months ago, July and August, and I think consumers didn't react too much to it back then. But I think part of the reason was they thought it was temporary. And I think now that, consumers are just, what we're seeing over the last 4 months are increased spontaneous mentions of food prices and gas prices. So this is something that's not really limited to one part of the country. We're seeing this across the board.
Interesting.
Joanne, to what extent are we also seeing the impact finally of higher rates?
I think that's certainly part of it, but given how much, how focused consumers are on the types of purchases that really affect their lives, I think it does make sense that food and gas are really on the forefront of people's minds. Consumers have noted the effect of higher interest rates on the purchases that they do need to do, for example, durables and autos, and so we're seeing consumers notice those higher interest rates, but in terms of, active, conscious reactions to interest rates, that's probably not this month's increase, but certainly the pass-through to consumers, that's certainly part of it.
I wonder, Joanne, how are people feeling about what's happening in D.C., and is it hitting their radar yet in terms of the House not having a speaker and the dysfunction there?
We are hearing that mentioned by some consumers, but I think also the House dysfunction is a continuation of what we were seeing over the last few months with the close call with the federal government shutdown. So I think consumers are absolutely frustrated at the dysfunction in Washington, and they're reserving judgment about how that's going to look going forward. Certainly, if a federal shutdown does come to pass, what we've seen in previous shutdowns is that consumers absolutely do react to that, and sentiment is likely to decline even further if that happens.
Joanne, one final quick question. It won't be captured by this data, but we've just seen the start of another major global conflict. Historically, how do consumers react to news such as this? We've seen the war in Ukraine, but now we've got the emerging conflict that we see in Israel. How would you expect the consumer to react to that?
I think that consumers will absolutely, their attitudes will definitely deteriorate if this conflict continues to escalate, and especially if this provides even more disruptions to supply chains or gas or fuel prices. It will certainly affect consumers and their attitudes towards the economy.
All right, Joanne, look, we really appreciate the instant analysis. Thank you so very much. Joanne Shu, University of Michigan Surveys of Consumer Director. Just to reiterate, sentiment dropping, expectations for inflation rising. That's sort of the net here for UMich in October. All right, coming up, our question of the day, if we just take a look at the market reaction, is it risk off into the weekend? We're going to talk to Megan Horman, Verdant's Capital Advisors CIO, coming up next. This is Bloomberg.
In terms of the bond market,
these sort of day-to-day moves are quite astounding.
A lot of this is whipsaw. It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
There's been such an incredible move in yields, particularly over the last month.
We've seen this huge repricing in long-end yields, whether you look at 10-year Treasuries, 30-year Treasuries.
When things move this quickly over short periods of time, there's unrealized losses.
There's still some concerns of weakness in the economy, still some concerns about international stability.
The situation in the Middle East is very volatile.
It is one more catalyst for volatility.
Over the medium term, it is, we think, inflation that's going to be underpin market direction if it comes back.
That in itself is going to be another support for yields moving a little higher. I'd like to see them settle.
You're going to see the trend towards lower yields in the early part of next year.
The market is just trying to find its equilibrium right now.
It could be a volatile period.
I do expect this ongoing volatility.
Those are Bloomberg TV guests weighing in on the volatile state of markets. And that really brings us to the question of the day. As equities give up some of their gains, money still flows into the long end of the bond market. Is it risk off into the weekend? Let's ask Megan Horman, Verdant's Capital Advisor, CIO. Megan, good to see you. Is it risk off right now?
It doesn't look like it in the market action today. However, we have seen the equities pull back from their highs after we got that University of Michigan Consumer Confidence Index. Again, it's a long day. We still have a lot more trading to go. I think there could be some fading of this rally into the end of the day ahead of the weekend, especially given the really pitiful number that we just got from consumer confidence. And then there's, the Middle East conflict is still front and center to most people's minds.
What does being defensive mean to you, Megan? If you want to be defensive right now, how do you achieve that?
Well, it's nice to be in cash right now, to have an overweight cash position. This gives you not only the ability to earn a healthy yield, but also you can take advantage of the volatility that we expect will continue for the rest of this year. Remember that we still think that there's a recession that's unavoidable, but there tends to be opportunities for the long run if you have dry powder to put to work.
Where? Like what? I guess what would be a trigger to put that dry powder to work that would make you feel like to make a safer investment?
Well, first of all, there needs to be some realistic, expectations from a valuation perspective. Valuations right now in a lot of the area of the large cap market, for example, is still high, given the expectation that the Fed, we think, still has probably one more rate hike in them. They're not going to be cutting anytime soon, even if the economy starts to weaken. They just don't have the ability to do that. Inflation has been very tricky. It has been stubborn. The Fed doesn't even really see, if you look at their forecasts, for inflation to get down to that 2% level until 2025. So anybody who's looking for rate cuts to come in and save the day, I just don't think that they're here. So we think valuations need to get much more realistic to that expectation.
Megan, to that point, former St. Louis Fed's chief Jim Bullard, he's speaking at the IMF meeting right now, talking about the fact that markets may be underpricing the risk that inflation resumes its rise, and the Fed might have to hike to 6, maybe to 6.5% if that were to happen. What happens to financial markets if that scenario that Jim's laying out comes to pass?
Well, that's where we get that 10% or 10% plus correction in the market. The market is simply not pricing that in. The S&P 500 PE is around 20 to 21 times earnings. When you're looking at an interest rate environment that is that high, inflation that's that stubborn, the PE multiples should not be trading at 20 times earnings.
So what do you do with something like oil, which obviously has a feed through in terms of inflation? It feels like today it's being treated as a safety asset, as sort of like a hedge to the geopolitical risk, maybe I can say. So what do you do with that and then energy stocks that have been outperforming?
So we're not dumping money into energy stocks. I think that they've had a nice run. Instead, some of the sectors that we would focus on is those, like you had asked, the defensive sectors. So it's healthcare, staples over discretionary and tech. I think that oil has been relatively tame given what's going on in the Middle East, but we think that it does continue to put pressure. We talk about higher for longer with interest rates. We think higher for longer with oil prices as well.
Megan, a lot of people are coming out of the market right now. They're doing what you're saying, and they're going into cash. You just look at the BlackRock numbers today in terms of the withdrawals that they're seeing. Clearly, a lot of people are thinking this. Getting back in, that's the thing that I'm beginning to think about. How are people thinking about getting back in? It's the question that I want to know. Everybody's saying to me, get into cash, but then what? What kind of triggers are you going to be looking for?
Yeah, that's a great question. It's one that some of our clients ask us as well. And basically, there's a couple things. First of all, stocks rarely, if ever, bottom before a recession. And given the fact that we think a recession is still likely, could possibly even start in the fourth quarter of this year, if you look at those consumer confidence numbers, that typically does tend to be a leading indicator for spending. So if it doesn't start in this quarter, at least the first half of next year. So we think the volatility in the equities is here to stay. We think that, as I mentioned, the PE multiples are way too high. We need to get some more realistic expectations there. That's what we're going to look at. When valuations and the fundamental picture all starts to come together, that's where we'll start to put money to work.
Megan, are banks on your list? I mean, in some ways, they're perfectly set, in some ways, to manage volatility, say, through the investment banking and trading divisions. But then on the other side, they're dealing with the consumer issue. I mean, we saw reserve releases for J.P. Morgan, but then, of course, Jamie Dimon worrying about dangerous times ahead.
Mm-hmm. Yeah, I mean, the financials are a very interesting area to look in, but it's a very broad area too. Right now, we're not, looking at the financials to add money into them at this point. I'm more concerned, as you mentioned, the consumer, not only the consumer, but businesses. Take a look at the small business, the loan rates on that. These are very high. This is going to start filtering into the small businesses. The consumer, as we mentioned, auto loans. You heard from some of the big banks today that they're seeing a big uptick in the auto loan delinquencies. We haven't even talked about the small and mid-cap banks yet. Now, I know that their PE multiples are attractive if you look at them, but whatever happened to the first quarter of this year when we saw the biggest problem they had was the rise in treasury yields and what it did to their balance sheets? No one's talking about that, and yet we're even higher than we were then from an interest rate perspective. So I think that there still is a lot of trouble that could be brewing in the banking sector. We're just not comfortable there yet.
Yeah. All right, Megan, thanks a lot. We really appreciate it. Megan Horman, Verdence Capital Advisors, CIO. Thank you very much. All right, it is 16 past 7 on the West Coast. We want to get you to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its gorgeous morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. And Ed, we are inching towards a historic moment in space. A NASA probe sitting on top of the SpaceX Falcon Heavy rocket is set for an unprecedented journey into space. I think it's going to last about 8 years. What are we looking at? What are we expecting?
Yeah, I mean, what you're looking at literally is the nose cone carrying the payload atop that Falcon Heavy. And whether you're a space nerd or you are a human being, it's an important mission. That payload over a 6-year period is heading toward an asteroid called Psyche, which is currently orbiting somewhere between Jupiter and Mars. And the hypothesis is that asteroid is the remnants of the core of a planet. And so the question that NASA is trying to first pose is that the case? But the bigger picture is, by using what's in that nose cone, the payload, a sort of trio of very high-tech sensors and instruments, can we learn something about our own core here on planet Earth and the future of this planet based on the sort of elemental composition of that asteroid?
Ed, talk to me about SpaceX and NASA coming together and the significance of this mission on that front.
Yeah, I mean, mechanically, this is the first time that NASA will do any sort of deep space exploratory mission using Falcon Heavy. The mechanics of the relationship has so far largely been Falcon 9, and as we've done many times on this program, and I've enjoyed every one of them, it's been a relationship where SpaceX ferries astronauts to and from the International Space Station in the Dragon capsule or resupplies, and those contracts between NASA and SpaceX run into the billions. This is a payload that is non-human. They are scientific instruments and pieces of technology to gather data, but it's a next step forward, and it's a $1 billion project, so this is big.
We're counting down here. We're just about a minute away from launch. Ed, how much is SpaceX making from this?
This is the thing. You think about a per launch, the numbers vary from the sort of high tens of millions and above. The key point of the economics is the cadence of launch and the supply chain that SpaceX has established to make a reusable rocket, in the first instance, break even, and then make cash.
Is it startup? Now we're going to get the go.
So we're about to just walk me through the next few minutes, Ed. We're 45 seconds away from launch.
Yep, so as you see, you have the main booster, and it's shrouded by the vapor, a byproduct of kind of the systems in preparation of launch. But those two side boosters and main booster will be taking this beyond Earth's atmosphere. It's about an 8.5-minute process to kind of get into orbit before anything really happens. But, you know, the key moments to kind of look out for are max Q, maximum pressure or aerodynamic stress on the rocket after about a minute, and then we'll see it all happen pretty quick.
T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, engine ignition. And liftoff. Liftoff of Falcon Heavy and Psyche on a mission to a metal asteroid in deep space to study the building blocks of our planet's inner space.
Vehicles pitching downrange. M1D chamber pressure is nominal.
View there from the on-board camera on the booster. Beautiful shot there as it goes through the clouds.
Power and telemetry nominal.
Over here, Joe, the power telemetry are nominal. We're also looking at the data for all 27 engines. And
Falcon is supersonic.
All chamber pressures look good, and Falcon is supersonic now.
Throttling down in preparation for max Q. Along with peak mechanical stress on the rocket.
What will happen here
Max Q.
The side boosters will be at full power, and the center core will be at a reduced power to go through max Q to reduce the pressures on the structure of the launch vehicle.
Coming up in 30 seconds. We'll start getting ready to have those boosters cut off.
Vehicle's looking good, pitching downrange. All telemetry looks really good so far, Daryl. So we see a beautiful view of the Falcon Heavy and center core and side boosters there. Data is looking really good.
All 27 engines of the Falcon Heavy putting down 5.1 million pounds of thrust. Standing by now for booster engine cutoff for those side boosters. The center core booster will continue on.
Booster engine cutoff. Side booster separation confirmed.
Great shot there of the side boosters coming off the rocket.
MVAC engine chill has started.
And there we start the chill on stage 2 as we get ready for MECO on the center core. Stage 2 will continue chilling down, making sure the fuel and propellants are flowing through that MVAC, getting ready for ignition.
Those boosters will have 3 burns.
At its absolute top speed, Falcon Heavy traveling at like 24,000 miles per hour. What you saw was those side boosters separate from the main booster. They are now going to fall back down to Earth. They're going to do what's called a boost back burn, kind of orient themselves correctly, go back down towards Earth, and they will attempt to land both of those side boosters, guys. But my understanding is they won't try and recover the main booster, you know, which they normally do with Falcon 9.
And Ed, this is going to be a long process, right? Because now it goes 6 years, right? It's going to take 6 years to get to the asteroid and then 2 years to circle it, right?
Well, here on Bloomberg Markets, and you know the European closes up next, we do expect some things to happen in the next hour, but yeah, after that it's around a 6-year journey. The first stop is Mars, and it's really interesting actually, because what happens is the propulsion, they use the gravity field of Mars to kind of slingshot themselves towards the next stage of the journey, which is this asteroid belt, as I said, between Mars and Jupiter. And then after that, it's basically a solar-powered electric propulsion system to get it the rest of the way. The thrusters are powered by solar, which is pretty neat, right? Like, you're getting close to the sun. What you just saw, by the way, was first and second stage separation, which also is pretty neat.
What a beautiful shot there.
This looks like it's going like clockwork. I obviously don't want to jinx it. It is Friday the 13th, which I thought was a brave call on their part to launch on a day like today. But what's happening behind the scenes here? Are we seeing an acceleration of the scientific community now that they have usable, reusable, relatively cheap and kind of scalable technology to get technology into space? What's happening behind the scenes in terms of the scientific endeavors being pursued?
So it's this is the fantastic question. I think we probably focus on SpaceX, right, in the context of it being the world's most valuable startup. You know, my colleagues and I reported recently that based on a secondary they were doing, the valuations like $150 billion, money, etc. But the story that you're speaking to is critically important, that they've basically lowered the threshold for entry. So if you're a little satellite maker here in Silicon Valley in Europe, you can catch a ride now. You can put your little payload into orbit at a cost that's realistic. And what we're talking about is public sector money, right? And that has a limit to it. So I think that's the right question, Guy. And in this case, though, reminder that this mission's about $1 billion for NASA, but NASA's got the budget.
Hey, so what is the payload?
On the right-hand side.
I love this question. Let's get super niche, super deep. There's basically a triumvirate of sensors that want to gather particular data from the asteroid psyche. The first is a gamma-ray neutrospectrometer, and basically what that does is measure the elemental composition of the asteroid. It is a metal asteroid, but remember the hypothesis is that it's a remnant of a core, a planet core. The next one's a magnetometer. That basically measures the magnetic field that's left around Psyche, and that's important because if there is some sort of remnant of magnetic field, it does indicate to us that was once a core, and then you can use a radio and cameras to kind of map out the rest of that gravity field and the sort of shape and composition of the core. And all of that data is actually going to test another system called Deep Space Optical Communications, the DSOC system. Because as I said, this asteroid is between Mars and Jupiter. That's very far away. How are they going to get the data back to Earth? The answer is basically high bandwidth optical communications. You know, sending stuff all the way back using a new level of near-infrared laser. So basically, layman's terms, a lot of tech on board.
Thank you for that.
That's the simple answer. Right? We'll take that. We'll take that one. And then what does that teach us about us? What does that teach us about our planet?
This is where not my enthusiasm or my wanting to know, but basically my knowledge runs out. I think that the idea is that if you're a geologist and an Earth scientist and you just see the side booster, one of them at least, re-enter Earth's atmosphere, and as we said, they'll try and land both of the side boosters back on Earth. You know, basically, I think that we look at the life cycle of planets and stars, and we try and work out what on Earth is going to happen to planet Earth over like a very, very long time period. Don't worry about our lifetime, guys. Don't see this as a stressful sort of.
Yeah.
I don't even want to use the word. You know what I'm trying to say?
Yeah. We've got sort of issues that we need to deal with right now. Yeah, I appreciate the fact that this may be further out.
Hey Ed, I also like the fact that you distinguish between space nerds and humans. So if Guy and I are humans, you tread the water here. What are we watching right now? On the left-hand side?
You're watching, I think, them cycling through shots of both side boosters, landing on Earth, designated launch pads. There's one of them, it looks nominal. Nominal meaning as in everything went fine. The second one touching down, everything looks nominal, that looks fine. Where are we? We're 8 minutes and 25 seconds into the mission. In about 56 minutes time, the Psyche payload will deploy and send on its 6-year journey. So there you go.
and then the call out.
Amazing stuff.
It's amazing. It looks like CGI when these things are coming in.
It does, doesn't it?
It is absolutely incredible to see this stuff actually happening and the reality of it. That you can land 2 boosters. This is proper sci-fi stuff. Absolutely incredible. Ed, just talk me through kind of what the next mission is. What are these 2 side boosters going to be used for next? What is SpaceX's next big step forward?
Oh, I honestly don't know the answer. I don't think that there is a Falcon Heavy mission scheduled. This is only the 8th time that the Falcon Heavy system has ever launched. Remember, it's not the future. The future is Starship, and I think we're all waiting to see SpaceX put that next-gen Starship to the test again, because they got it off the launch pad last time earlier in the year, remember, but it exploded.
Ed, thanks a lot. We really appreciate it. I feel like these launches now for all of us are becoming more rote, which is kind of incredible and amazing. Thank you for taking us through everything there, Bloomberg's Ed Ludlow. And definitely catch Ed and Caroline Hyde on Bloomberg Tech. That's coming up in about 90 minutes time. And we're about an hour into U.S. trading session. Equities now a little mixed. NASDAQ 100 flipping into negative territory. Bonds still getting a bid after that disappointing UMISH report at the top of the hour. Abigail's tracking those moves. Abby?
Yeah, relatively small mixed moves here on this Friday, Alex. On the week, though, we are looking at gains for the S&P 500, a second up week in a row. The NASDAQ, we're looking at a third up week in a row. Weakness, though, for the Russell 2000, and this index has, in fact, put in what is called a death cross today, which signals technically that there could be some more selling pressure ahead. As for those yields that Alex was just talking about, if we take a look at what's happening over the last month, it's a real roller coaster ride for both the 2-year yield and the 10-year yield. You can see the 2-year yield, back above 5%, the 10-year yield at one point, the 10-year yield above the level of the last rate decision. It looks like technically it may hold 440. If that's the case, it could put pressure on the stocks. Although Mandy Zhu of SIBO yesterday made the point that rising rates here could be on the expectation of some sort of normalization, soft landing, and that may not pressure stocks in the same way. As for what's beneath the surface for the S&P 500, that relatively benign loss on the day, JP Morgan, a barometer of the banks here, up 2.7%. They, of course, put up a surprise beat for fixed income. Equities a little bit weak, but their loan loss provisions, their net interest income fiscal year guide better than expected, and then loans up 17% in the third quarter, better than expected. Progressive, a strong quarter. Analysts positive on the fact that they are likely to keep $9 per profit and on the quarter, and then we can see some laggards here, Alex.
Yep. Netflix thing coming out next week with numbers, so is Tesla. All right, Abby, thanks a lot. Really appreciate it. Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. Let's get more into the U.S. bank earnings. Joining us now, Bloomberg's Shonali Basak. Were you surprised at how strong across the board these guys were?
Listen, a lot of these banks have sold off pretty meaningfully this year, and if you took a look of the big six, you only had JP Morgan really up on the year. But JP Morgan, when they're raising their guidance for net interest income, the fact that they're doing it for the 4th time this year, of course they're going to get some love. Wells Fargo and JP Morgan also coming in very meaningfully in terms of credit losses, in terms of write-downs. Altogether, the big 3 banks, JP Morgan, Wells Fargo, Citigroup, took in more than $1 billion less of credit write-downs than you had expected. So things were meaningfully better in terms of loans going bad across those 3 banks. So you are seeing the lift, but take a look at the KBW Bank Index today. It's pretty remarkable, the divergence between the biggest banks and the rest of the industry. PNC also reported is down almost 2% on the day. And so that divergence between big and regional is certainly continuing on the heels of these results. And that choppiness is to be expected through the rest of the season.
Shai, this is going to sound like a weird question, but it actually makes sense in the light of what you just said. Are the big banks a good guide to what is happening with the U.S. economy?
Listen, one number that we love to look at, I know we talk about this every time and more so, is when Bank of America reports on Tuesday, I always look at that FICO score trending up. In addition to what the loan books look like, where are they lending? When you look at Wells Fargo's loan book, even though they're increasing their net interest income, the more economically sensitive parts of the economy, home loans, auto, are still under pressure. They're just not feeling the same pains as they were before because they've done a lot of cleanup in those books. And so when you think about the region, regionals, you're right, they are much more exposed to those economically sensitive parts of the economy that are very much clearly feeling more pain than the clients that you're seeing at these big banks. And something interesting here too, if you're thinking about Wall Street businesses, JP Morgan, look at its private bank and the revenue just really surging in the most recent quarter. The higher net worth individuals are clearly creating benefit here to the biggest banks, which again will fare well for Morgan Stanley as well on Wednesday if they can keep up with this pace.
No, that's a good point. What did you make of Jamie Dimon saying that's the most dangerous time the world has seen in decades? Like, what was the context for that? And did he address that more on the call?
So the context here, and he addressed it very much in the statement, he gave a bunch of factors, including still the ongoing war in Ukraine, the Israel-Hamas war, the food and energy concerns, the pricing around them around the world, and separately, not related to the danger, but he's talked about the market concerns there are about quantitative tightening and what that could mean. And so, yes, a lot of concerns, clearly. In the near term, honestly, because of the volatility of the markets, stocks, bonds, currencies, commodities, particularly rates and commodities, Citigroup had the best third quarter in a decade on the heels of these moves in markets. So unless that turns to stifling, these banks are still getting a benefit from those trading businesses that could also be continuing to see big investment banks next week.
And this is really interesting because in some ways, Citi's about Jane Fraser right now. Citi's about the turnaround story. Citi's about this long-term project that she's putting into place. These numbers, in some ways, aren't a reflection of that, are they?
The future is very important, and even Jamie Dimon and JP Morgan are telling you that things may not be at this level forever. Things will normalize, both in terms of the revenue side as well as the cost tied to credit. Jane Fraser's turnaround story here is quite remarkable. This is a pretty pivotal quarter to show numbers like this as she started this next phase of the restructuring, if you will, because not only have they changed management at those very key businesses, trading, investment banking, you're also watching Citi here now saying they're going to remove 5 layers of management. 5 layers. And so that will come with costs. That will come with severance costs. And that has to be accounted for in the upcoming quarters.
Great stuff, Shonali. Busy day for Shonali Basak. Thank you very much indeed. Busy week next week as well, as she's alluded to. Shonali's going to be back a little bit later. We'll update you on the calls. We'll make sure you're up to speed with what is being said. I want to update you on another piece of news right now. Sean Fain, I think he started a little bit late, but the gist of the statement that he's been giving us this Friday is that talks are progressing. As a result, it doesn't look like we're going to see extra strikes coming from the UAW that are going to impact the big 3 automakers. It does seem as if maybe some progress is being made. It was interesting to hear Ford talking a little earlier on about the fact that basically they've given all they can give. They can tweak things, they can change things within the package, but they're kind of as far as they can, they've gone as far as they can go. So we'll see whether or not next week we see some of that progress resulting in some of these strikes being rolled back, but we'll wait and we'll watch. But that's the latest from Sean Fain and the UAW. I want to get back to the bank story and talk about what is happening here. So far, so good, seems to be the narrative. Bill Smead, founder and chairman and chief investment officer at Smead Capital Management, joins us now. They hold JP Morgan, they hold Bank of America, they've got American Express in the portfolio as well. He joins us now from Seattle. Bill, these numbers look strong. As an investor, are you happy with what you're seeing here?
Well, of course we are. We've owned JP Morgan and Bank of America since 2012. So the way we look at them right now is they're doing a really good job of running their business, and the things they don't control have a lot to do with how cheap the stocks are in relation to the rest of the stock market. So that's a self-healing thing. And then secondarily, you have to kind of understand where we are from a historical perspective. I think you just had the segment about the rockets going into outer space, right? So what time period did we have rockets going into outer space? Very high fiscal deficits that got monetized in the Vietnam War and Johnson's Great Society, and Arab oil embargoes and inflation that seemed harder to control than what you wanted. So the answer is welcome to the late 1960s. Warren Buffett got so frustrated with those circumstances he closed his partnership. So it's quite a good lead. And so the banks are trying to deal with the fact that you kind of know there's got to be some kind of a comeuppance in the stock market over the next 3 or 4 years.
So, Bill,
and yeah.
Does that mean that the banks for you are playing defense, or you just own them for so long you're just going to hang tight?
No, they're very inexpensive relative to everything else we could own, and that makes them very attractive. Nothing I like more than sitting here at 4 times plus dividends what I paid for something, and it's been cheapened up by the circumstances that they don't control. If they've shot themselves in the foot, we have a problem. But this is just the normal ups and downs of markets and the normal ups and downs of the economy.
Okay, would you buy more of them?
If I didn't own them, I'd be buying them.
Would you add to your position? Would you add a position though now?
I can't tell you things like that.
Why not?
Because I can only tell you that after the end of each quarter.
Fine. Okay. We'll take back to the end. Fine.
So in terms of if you're looking at the economy, describe to me, you just kind of walk me through what you think is the relationship between what is going on in the economy right now, what's going on with fiscal deficits, what's happening with the government, rockets going into space. This is the 1960s. Is that the message that the banks are delivering? Because these are really strong numbers, and I'm wondering, and I asked this question to Shalani just a moment ago, are big banks a good guide as to what America's economy really looks like?
Well, their stocks are a good guide to what the average stock is doing, right? If you take out the Magnificent Seven, stocks have made no money this year, right? The vast majority of S&P 500 stocks are down for the year. So to go back to your question, the economy's strong because when you pump $10 trillion of monetized fiscal deficits into the system, when you hand out tax credits for environmental clean energy investments like candy, and then you have 92 million millennials who were late to get started on household formation, waking up 2 or 3 years ago and starting to get married, have kids, buy houses. There's an underlying positive current to this economy that has nothing to do with policymakers, and therefore the frustration is we think that Chairman Powell and the Fed are a brain surgeon, but inflation is a cancer. So we have a brain doctor working on a topic that needs a cancer doctor. And therefore, they're unlikely to solve the inflation problem, just as unlikely as it was in the 1970s when those Fed chairs were trying to do it.
So, okay, that definitely feels like higher rates for longer in a big way. Can I just ask you about oil for a sec? Because we are seeing oil rally. That's a geopolitical issue. But we also had that major oil merger this week, Exxon Pioneer. And the talk on the ground is that we're going to see a lot of buyouts now, a lot of targets that are private, but also public, like a Devon or an EOG is sort of on the table. Are you playing that trend at all, Bill?
Well, we have about 25% of our portfolio in oil and gas. And we own Ovintiv, Apache, and Devon. And we wrote a piece 3 months ago basically saying we expect people are going to drill for oil on the New York Stock Exchange. And that's what it is. Exxon just drilled for oil. And if you buy a company with existing wells and existing production and expand the life of your business by buying another company, you're not going to get the condemnation from the environmental people on poking holes in a new place. So it's just, there is going to be mass consolidation in this industry, and there's a huge gap between the price to free cash flow and the price to earnings of the everybody below 40 billion in market cap versus the Chevrons and Exxons that the big money had to crawl into because of lack of liquidity.
Well, if you look out of the window of the building you're in right now, you're going to see Amazon, you're going to see a range of technology companies. I'm wondering what you think of them right now in a world that you're describing that kind of points us in the direction of much higher yields from here. Do those big technology companies look like good investments to you right now?
Well, first of all, what I see looking from the window I'm at in Seattle is a bunch of partially, mostly empty office buildings. A place where just thousands and thousands of people, including myself for 40 years, came to work. I'm in a building that I worked in the mid-1980s when it opened brand new. And so the fact of the matter is, one of the reasons the regional banks are performing poorly relative to the big banks is because the regional banks are much more exposed to commercial real estate of the office building type, as opposed to Bank of America and JP Morgan. So the answer is, I see that. That was created by a boom that came from Amazon parking 50,000 people in downtown Seattle, and I just walked by a building that Amazon built that is now being turned into residences because there's no one in it at Rainier Square.
So they felt like that was a knock on corporate real estate and also maybe a little bit on tech. Bill, listen, we really appreciate it. We got to go, but thank you for joining us. Tell Cole we say hi. Bill Smead of Smead Capital Management. And speaking of banks, we will be hearing with Wells Fargo Bank CFO on Bloomberg Television. That's coming up at 2 p.m. at New York time. We have some breaking news for you. Sean Fain, the UAW president, is speaking now at a Facebook Live event. In the latest update on the auto workers' strike, car makers have been spared from new strikes. This is as talks progress. You can watch more in real time at LiveGo.
Companies and the corporate media tried to scare everyone about the devastation our strike would cause. They tried to convince everyone that it's dangerous for the working class to fight for more. Instead, they're learning a hard fact. The working class in this country is fed up with being bullied by rich corporations and the wealthy. The working class in this country is sticking together. The longer our strike goes on, the more the public stands with us. The longer our strike goes on, the more the public turns against corporate greed at the big three.
The broadest S&P 500 tracking ETFs are seeing above average inflows. Want to find out what's kind of driving this trend in today's ETF Friday. Bloomberg's Emily Grafeo is here with the details. All right, Emily, what's driving it? So the underperformance of active this year seems to be driving extra flows into S&P 500 ETFs and more broadly passive strategies. There's only 4 ETFs that track the S&P 500, and those 4 ETFs have taken in 27% of all equity inflows this year. And not only is that a big change from last year when they took in about 10%, it's also the highest proportion since 2016. So it seems like investors here are looking at the performance of big tech, which is really a large part of the S&P 500, and just allocating to that passive strategy as opposed to some of the active here.
In theory, Emily, single stock correlations are really low right now. You're getting some really big movements within the market. This should be a great time for active. But that's not the message you're giving me, it sounds like.
No, I mean, if you look at active ETFs, and there's not a lot of active ETFs. The active management ETFs only started a few years ago, but only 28% of them are beating the S&P 500. And it's not just active funds that are core equity, but if you look across ESG, thematic, factor-based funds that Bloomberg Intelligence tracks, most of them, a majority, are actually underperforming the S&P 500. And this is a sea change from last year when we saw factor ETFs, 70% of them were beating the S&P 500, now only 15%. So think value, growth, tilted funds, those are all underperforming.
Guy, I have to wonder if this goes to your whole theory that the narratives change so quickly, so you just can't, and I appreciate that that's where active should be good, but when the narrative literally whipsaws daily, it feels that creates problems for this.
Yeah, in theory, this should be a great environment, but you need some momentum within some of these trends. And that's been where the real challenge has been. Yes, you're getting low correlations, and yes, you're getting things bouncing around all over the place, but there's nothing seems to last for long. So even if you get it right, you're going to get it wrong pretty quickly.
Right, hence the factor investing in last year, a different story. So Emily, I'm also wondering, end of year balance, rebalancing and all that stuff. I feel like we usually talk about it after November, but I'm wondering if this is a little bit different because we've seen so many big moves. Are you seeing some of that? Like, do you think that's part of it? Yeah, you might expect to see, maybe because of the fact that passive has done so well, now some funds think big model portfolios shifting out of that passive allocation, but we'll really have to see. We have a lot of index rebalances coming up into the end of the quarter. And actually, if we're talking about indexes, FTSE Russell is now considering doing a second annual rebalance, so changing it from annual to semi-annual. We just had that announcement a few days ago. So that might even bring in more volatility, more movement when it comes to these big funds shifting from active to passive.
It's amazing, isn't it? In some ways, this would be such a great environment. Emily, thank you very much indeed. Emily Grafeo joining us at ETF Friday. Alex, you want a great example of this? Look at LVMH versus Novo Nordisk.
Yes.
I think the gap now, LVMH used to be the richest company in Europe. It's now Novo Nordisk, and the gap, I think, is now 100 billion. The speed at which this has all happened, absolutely eye-watering.
Yep, and sort of, how do you play that trade now, right? Like, we got sort of a sales and rev outlook for Novo Nordisk. It was released accidentally earlier today, but it was super solid, right?
Yep.
It drags up its peers, but at this point, how do you not own it, but then how do you buy it at this point? So I don't know how you manage that.
Absolutely, and it's the same story as big tech as well in the United States.
Sure.
But you look at how fast the luxury sector has fallen in Europe. It's been eye-watering. The value destruction there has been seismic as the Chinese, then the American, then the European consumer starts to roll over in a big way. Absolutely amazing to see this all happening. Anyway, we'll talk about Novo Nordisk in the next hour. Much more to come in the European close on that story. This is Bloomberg.